All right, so we're going to talk about cap rates, and we are going to uncover the truth about cap rates. There's a couple of definitions when it comes to capitalization rate or cap rate. You know, what a cap rate is the net operating income divided by the purchase price of an asset. It's also used to indicate the rate of return that is expected to be generated on a real estate investment property. That's Investopedia's definition. So if you go to Wikipedia, Wikipedia says a capitalization rate is calculated using a measure of the cash flow, calling the net operating income, and dividing that by the purchase price of the asset or the value of the asset. So the question is, what really is a cap rate? So we know how you derive the cap rate. You take the net operating income, divide it by the value of the property, asking price of the property, sales price of the property. So appraisers use it to value property. Banks use it to size loans, to evaluate markets and evaluate the deal. Investors use it to try to understand the value of properties and markets, and different properties in different areas will have different cap rates. Different types of assets will have different cap rates. Different types of properties will have different cap rates. So it's very confusing. So a lot of people will say that a cap rate is a yield on an unlevered investment, which it really is. If you're paying cash for an asset and it's stabilized, so the key here is stabilized. So if you're looking at the net operating income of a stabilized asset, and you're getting a yield on that asset. Let's say you paid $1 million, your yield is $50,000. You've got some closing costs and things like that when you buy it. You factor those in. You're going to have a net return, if it's a 5 cap of 5%, right? So that's what that's telling you on a stabilized asset. Where cap rates get really confusing is when you have a vacant property, partially vacant property, underperforming property, things like that. So let's say the property is just underperforming and it's running about 50% of the NOI that you know that it should be running at. Maybe the rents are low or the vacancies are high, or it's just mismanaged. And you know that you can get in there and drive the rent on that property and drive the income on that property to where maybe you're going in at a 2, 3, 4 cap on a property that ideally should be trading at a much higher cap rate if it's fully stabilized and fully renovated, and you've got the rents at market levels and all of those types of things. So this is where cap rates get really confusing for people, is that you can't really use a cap rate to judge an opportunistic investment or a value add investment or anything like that. You have to look at the investment itself. What is the actual occupancy, vacancy? What's the economic occupancy? In other words, it might be fully occupied, but how many of them are paying? What do the concessions look like? It might be fully occupied, but if they gave free rent to everybody to get them in there, that could be a problem just to make it look, occupied. So you want to really scrutinize the numbers, really scrutinize the income, the expenses, the trailing 12, the trailing 3, and even monthly in this current environment that we're in right now in 2020. So you want to scrutinize it on a month-to-month basis, and then even down to the week, before you go to closing. And that's what the lenders are going to be asking for right now in this environment. They want to know up to the minute before closing that property is doing what it says it's doing. So in terms of a cap rate, it is used by appraisers to value properties. It's used by investors to gauge a return on an unlevered purchase, an unlevered funding of an asset. So it is used as a return in the way to measure a return, but that's on a stabilized asset. And you have to include all of your costs of that transaction when you close it in order to get a true idea of what your actual return is. And then when you go to sell the property, let's say you're doing an opportunistic or value add or even just a core plus, and you increase the net operating income, then you have to kind of understand or try to understand what are the cap rates going to be at exit. What are you going to shoot for when you exit the property? And that's the thing that nobody knows. We know what the cap rates are today, and we know what values are today. And just like an appraisal, a property is worth whatever somebody's willing to pay at any point in time. That's what an appraisal is. That's an opinion of value. It's not a fact. So value is, in any asset class or any type of really anything, the value is what somebody's willing to pay at any point in time. So remember, appraisals are an opinion of value. Cap rates are an opinion of value. They are the sentiment of the investors and the market as a whole in terms of what the value of those assets are and what they're willing to pay for yield. And that's really what it boils down to. So is it an unlevered, does it measure an unlevered return? Sure, if it's stabilized. Is it a true indicator of the value of a property? No, if it's not stabilized, if it's vacant or is a value add or an opportunistic where the income is not where it should be based on market comps, market rates, and things like that. So that is a quick rundown about what a real understanding of what the cap rate means on a property. Be careful, don't buy just on cap rate. It can help you understand a market. It can help you understand a type and class of property, and it can help you understand what investors are willing to pay, but it is not always a real indication of the actual performance of the property.